Hi guys, Joe Neighbour here from Signal Centre, one of the directors here at Signal Centre. And if you've seen the last few days, we've been putting out a few webinars on various topics to try and help you all with your trading and investing. And obviously during these crazy times, we should all have an extra bit of time on your hands, which I'm obviously sure you wish you didn't, and life was normal, but unfortunately it isn't for now. So we're using this as an opportunity to try and offer some free education. So today I'm going to talk about position sizing and touch upon some topics about risk management as well. We can obviously talk about charts and chart patterns, which has been done over the last couple of days with Steve and Ian on various topics. But risk management is a key part of trading, and that's what's going to ultimately keep you in the game for a longer period of time and make sure that you make sure you win out over the longer term. So let's crack on with this. So what I'm going to go through today, I'm going to talk about position sizing. I'm going to talk about counting your returns using R multiples or R rather than talking about pips. I'm going to talk about how to calculate your position sizes and go through some calculations on that. I'm going to talk about some other bits and pieces as well. Why not to trade too big or too small, how to stay consistent. I'm going to touch upon some tips on growing a small account, which may be useful for some of you. And then going to throw out some additional material and books that may help you along the way on your journey. Again, if you have any questions with anything that we are talking about, whether or not you're watching this live or whether you're watching it on catch up, feel free to send us messages. We're pretty active on Telegram. Happy to answer your questions on email, and also happy if you want to add us on Skype. Okay, so let's move on to position sizing and counting your returns using R. Now, often when we are talking about how much we make, win or lose on a trade, often we'll refer to that as how much R we've made. Now, the concept of R or R multiple is particularly popular amongst professional traders. You may have seen people using it or talking about it on things like Twitter. R is simply stands for risk. It's how much money you've risked on each trade. So rather than going around telling everybody how much you've risked on each trade, you can just simply use the phrase R, and then that sort of gets around that issue of people asking you, how much you made or how much you've risked. You can simply talk to them in the form of R. So as I said, R represents risk and it measures the distance between the entry point of your trade and your stop loss order. That difference there is your R. Now, returns are personal to you. For me, when you talk about R and say over the course of a month, we made, I don't know, 10 R over the course of a month, that's a very clean and simple way of talking about performance rather than me just saying to you, this month we made 1,000 pips or we made 2,000 pips. It doesn't really mean a lot because obviously people trade and risk different amounts on these pips when they're talking about pips. And of course, when they're saying they've made 1,000 pips, how much did they risk in order to make those 1,000 pips? That's the key in all of this. We're talking about risk reward on a regular basis when we're talking on our channel. It's all about risk reward. So if someone tells me they've made 300 pips, but they've taken 250 pips worth of risk in order to achieve that, then, that's pretty silly in my eyes because you're risking almost 1-to-1 and the risk reward profile of that particular trade isn't very good. If someone says to me, Joe, I made 2.5 R on this trade, then whether or not they risked 100 pips to make 250 pips or whether they risked 25 pips to make 75 pips, I know that the risk reward on these trades are much better and you're positioning your trades correctly. So this is an example of R in practice. So I've just thrown out a NASDAQ example. I know a lot of you obviously trade foreign exchange, so the calculations will be slightly different, but this is NASDAQ. So let's suggest that we are buying NASDAQ at a price of 7,350. We're placing a stop loss at 7,300 and we've got a target of 7,500. So 50 points is the difference between our stop level and our entry level. Now, if your strategy is to risk £100 per trade, obviously everybody's different depending on how much you've got in your account and what your tolerance for risk is. But in this instance, we're saying we're risking £100 per trade. Then what you do is you divide the monetary value by the stop amount. So £100 divided by 50 equals 2. So therefore, if we're spread betting, we are going to say that the trade size is going to be £2 per point. If the trade is stopped out, we've lost our 50 points, then £2 a point times 50 equals £100. So that's how much I've risked on the trade. So I've positioned size, I've done a correct position size on the trade. I've limited my risk to £100 or 1R. That's what we're going to refer to as R. If the trade goes on to hit the target, then I would have made 150 points, the difference between entering at 350 and targeting 7,500. At £2 a point times 150, I've made £300 or 3R. So my risk reward on this trade was I was risking 1R to make 3R. Now, this is just an example on the right-hand side of our 1 year performance on NASDAQ. So I've gone back to the 26th of March, 2019. And these are all the trades that we've published in the NASDAQ in that period. So that's broken down into R. As you can see, we've placed 80 trades. We've had 44 wins, 31 losses, and 5 flat trades. So I think it's about a 55% win rate. I think I checked on the spreadsheet earlier. And the average R is 0.198 or 0.2 if you want to round it up, is how much we are on average making per trade on NASDAQ. So as you can see here in January, we are down 1.35 R. Here in April, we're up 7.2 R. So let's use £100 again. If I was risking £100 on NASDAQ in January, I would have lost £130. If I was trading in April, I would have made £720 and so on. So hopefully that's clear. If it's not, then obviously give us a shout and we'll be more than happy to talk you through that. Now, I've obviously talked about this using spread betting. Now, a lot of you obviously use MT4, MT5, so you will be using lot sizes. Now, you can do exactly the same thing. And what I recommend is using a calculator for that so that you're keeping your position sizes very accurate. Let me just share this screen for you. This is my FX book. I mean, lots of information on here anyway, but you've got a ready-made position size calculator here for you to use. So you type in the currency or use the drop down to pick the currency that your account is set in. So let's say sterling. Let's say we got £1,000 in our account. Let's say we want to risk 1% per trade. And let's say we have a stop loss of, I don't know, 25 pips. And we are trading US dollar CAD. So if we click calculate, what the position sizes do here and why it's a little bit more complicated is because it has to take into account the FX rate itself in order to come up with your position size. So, you know, you can set it up with a spreadsheet if you want, but, you know, you've got tools like this from my FX book, so you may as well use them. So in this instance, it's done the result for us. We are risking £10, 1% of our account. That's how many units we need to trade if we're doing it as a CFD. And this is how many we need to trade if we're doing it on a lots basis. So if you were buying with a 20 pip stop or selling with a 25 pip stop, you would need to risk 0.068 lots on your trade, and that would equate to a £10 loss or a 1% risk of your account. Okay, let's move back to the PowerPoint. Now, the question I get asked a lot is how much should I be risking on each trade? Well, of course, this comes down to your personality, your objectives. How much are you comfortable risking on your account? How much are you trying to make? One thing is important is to try and keep your emotions in check. And to do that, you know, how much you risk on each trade will go a long way in doing that. As soon as you are in a position where you've taken a trade and you're risking much more than you know you should be, it's going to keep you awake at night. It's going to make you check your phone every 5 seconds to see if something's moved, because quite frankly, you're too leveraged. You've got too much risk on the table. You shouldn't be feeling like that when you trade. It should be enough to make it worthwhile, that when you win, you know, enough to make a difference, but it also shouldn't be too much that it's going to worry you. If it is starting to worry you, it's going to really cloud your judgment. And examples of this that you will find particularly if you're in a position where you're facing a loss that you really don't want to take, and you know that you've taken on too much risk. And I'm sure you've all done it before if you've traded for any length of time. You're staring down the barrel of a loss on your phone or on your computer screen, and you're thinking, Jesus, I just can't lose that amount. So then all of a sudden you start moving your stop. When you start moving your stop, you can guarantee that that's going to lead to disaster. You're going to start moving it and moving it and moving it and moving it because you don't want to take the loss. You can't face up to the fact that you've got a losing trade, and what you originally set out to achieve is going the wrong way. So by having an amount at risk that you're comfortable with, you're not going to be getting in that situation where you think, okay, I need to keep moving this stop loss because I can't afford to take this loss. You've got to take the losses. You've got to move on. And if you position size correctly, and if you risk an amount that you're comfortable with, you're not going to get in those situations. So it's going to really keep your emotions in check. If you don't have any exit strategy, that's the other thing. If you're taking off a stop loss, you've just completely got rid of all exit strategy that you had on the trade. You're now thinking, I just want to get it back to break even. And often that won't happen. It will just continue to go against you. It's funny how these things work, but it will just keep squeezing and squeezing and squeezing you. And ultimately, it could end in disaster and you blowing your whole account. And that's just from one trade. You're only ever one trade away from blowing your account. So you've got to make sure that you have risk management parameters in place, and you must adhere to your stops. Now, when you're talking about how much you can risk, for me, I risk 1% of my account per trade. I've always, risked that amount. I don't see the point in risking any more. Things to consider. And reasons why I don't risk any more than that is that inevitably you will have losing streaks at some point. So if I'm risking 2 or 3% of my account and I go on an 8 or 9 losing streak of trades, which has happened on more than one occasion, then, if you're risking 3% a trade and all of a sudden you're down 27% in the space of a week by getting 9 trades wrong on the bounce, that's a pretty tough pill to swallow. I have other sort of rules in place that will prevent things like that from happening. For instance, if I lose more than 3% in a day, which would mean I get stopped out on 3 trades, then that's me done for the day. I stop trading. If it goes to 5% on the week, then I'm done for the week. So, it's worthwhile putting some parameters in place for these sort of things, but also it's worthwhile considering how much you risk on a per trade basis when you factor in things like losing streaks, which will happen. And if you're keeping a record of your trades that you're doing, then obviously you can refer back to periods in time where you've had losing streaks and see how that's have impacted your account and try and cut out those mistakes. The other thing is the win rate. So I have a win rate historically on my trade calls at Signal Centre around about 45%, I think. Which is pretty normal. I think industry sort of acceptance is around that kind of level. A lot of people are determined to, have really high win rates, but unfortunately, it's just not the case. It doesn't always work out that way. There's so many different factors that eat into that, whether it be, emotions or whatever else. So, for me, as I'm coming back to how much you risk on a per trade basis, it's 1%. If I'm adding to a trade, then I'll only add to a trade if I'm winning. I won't be adding to it if I'm averaging down. That's not a strategy that I employ for my own personal trading. And it's not one I've ever seen consistently work really ever in the past as well. So I'll risk 1%. If I'm adding to a trade in order to extend my exposure, then I'll risk another 1%. But my overall exposure on that trade will still remain 1%. So if I go long of the FTSE, for instance, at 6,000, if my target's, let's say, 6,200, if the trade goes to 6,100, then my first trade is taken care of. I'll probably move my stop up to make sure that I have a win regardless on that. And then any new trade that I add on that, I can risk 1%, but overall my risk is still going to be significantly less because I've already got the buffer of that winning position that I opened earlier. So that's the only instance that I would add or scale into an existing position. The other thing is to keep things consistent when you're trading. I did a poll a few months ago on the Telegram group asking people how much they risk per trade. The results were fairly mixed. A lot of people were in the sort of 2 to 5% category. And as I've said, if you go on that losing streak, particularly if you're risking something like 5%, you could really end up blowing yourself up on one losing streak. And losing streaks happen. They're just part of the business. So, you have to factor those into your thinking. But when I say keep it consistent, I really think you either need to pick a fixed amount of capital that you're going to risk on each trade. So if you decide it's going to be £50 is going to be my risk per trade, or £10 is what I'm going to risk per trade, stick to that amount. Or if it's going to be a percentage, then stick to that percentage. So if your account starts to grow, then the amount you risk per trade will grow as well if you are trading and risking a percentage amount of your account. You shouldn't ever let the convictions of your trade determine the size that you trade. So if you think, right, I really feel good about this one, I think that euro dollar looks spectacular here, I'm going to put, if you normally risk £100, you think I'm going to put £500 on this. Well, I've got the stats and thousands of trades worth of history to suggest to me that with a 45% win rate, there's no point in having a conviction on any single one trade. Trading, can often be random. I know that for looking back through history, I've got a 45% win rate. So there is no reason why I should place conviction any higher on one trade than I should over any other. So keep it consistent. You've got to trust your systems. And as I say, bear in mind things like win rate. And if you can keep these kind of statistics, they're going to help you avoid making mistakes going forward. So collect all the stats that you can, understand that losses will occur. And if you've got a plan in place that you have seen work for you and that works for you, stick to that and follow it as much as you can. Then you can start doing some testing. So can your system cope with you risking 1% per trade? Can you then start tweaking it a bit higher? Can it cope if you're risking 2% per trade? In fact, I might just try and get this spreadsheet up now, which is our spreadsheet, just to show you how different things can become when you start adding in higher amounts of risk on a per trade basis. Just bear with me 1 second. I've basically seen people have excellent strategies, but they've worked, but they've ended up blowing themselves to bits because they can't, because their positioning size is too aggressive. Let's just stick on all of these down to here. And let's go back over the last, let's go back to the start of the year. And the reason I'm going to do that is because I know we had a good January and we had a pretty poor February, but March has been pretty good as well. So let's just open this up. Just make sure that I've got the right screen. Hang on a second. This is our profit and loss sheet that we keep a total of all the trades that we do and that we publish via Signal Centre on our premium offering. So this is every trade that we've done since the 1st of January this year. And as you can see here, we've got some totals. In January, we was up 36R, down 6R in February, and up 30R so far in March. Nice steady upward trend. This is based on risking 1% of capital per trade. So there's two lines here. We've got risking 1%, which is the sized one, so the darker blue line, and the light line is a fixed amount. Now, if we start changing this and we start to get bigger numbers start to appear, so it's the sized one that's going to change. So we've gone from 1% making 46% with a drawdown of 15. Drawdowns are obviously very critical here. Now, if we jump that up to 2%, yes, our percentage return has increased quite dramatically, but so has the drawdown. Now, why this is important is because if you start to see big numbers of drawdown, if you see that your account has dropped by 33%, how is that going to make you feel? Are you going to start then questioning your strategy? Even though, if you had just kept it at 1%, you can see that you've got a good strategy with a good drawdown level. That's going to start eating into your mindset. And if we up that again to 3%, then all of a sudden, yes, we're making 93%, but we're having to deal with a 51% drawdown, which is pretty significant. If we keep sending that up even higher, up to 5%, yes, we're making good money, 83%. The actual return actually starts to diminish once you actually start increasing the amount of risk that you're putting on a per trade basis. And then we have a drawdown of 81%. So from a risk reward perspective, we're trying to, well, we've made 83%, but we've had to risk 81% in order to achieve that. Now, that doesn't work for me. I don't know if it works for anybody else, if you can deal with that kind of roller coaster of a ride. But what I would say is keep the risk per trade low. What you want to be trying to achieve is Sharpe ratios of above 2, which is a measurement between the drawdown and the uplift on your account. If you can keep that at a good level, then you're doing something right. So that's why I say, try and keep your trade sizes consistent, 1 to 2%, 3%. Sometimes if you've got a good system with a high win rate, touched upon there, we had a win rate of around about 45% since the start of the year. We've got a win rate of 45.8%, but we're making good returns because our risk reward overall is very good. On an average trade, we've got a risk reward of 3.3R. Okay, so hopefully that makes sense. Just go back to the PowerPoint. So the next thing, I'm going to talk about growing a small account. Now, everybody comes in, well, a lot of people come into the market with small money. Obviously you're going to start off with small money because you don't want to take a massive risk, and you want to sort of dip your toe in the water and see if it works for you and if there is any potential there to make money. One of the key issues that people have is that they come in with this mindset that this is a get rich quick scheme, and clearly it isn't. If you've traded any sort of period of time, suffered any sort of loss, unfortunately that is a rite of passage. You have to experience some pain in order to get better at trading. It's the same with anything. If you're training for a marathon, you've got to go through the hard yards of doing the training in order to get good at it, and it's the same with trading. But when it comes to growing a small account, one of the key tips I would say is that compounding gains is one of the key things here. It's compounding it can be your best friend. The effects of compounding will have a much bigger impact on your account over a longer period of time, and they will prevent big drawdowns. So as I showed you that spreadsheet a little while ago, risking 1% per trade, as my account grows, I'm still risking 1% of my pot. So if I go from 5,000 in my account to 6,000, then my risk per trade on a 1% basis has gone from risking £50 to now risking £60 a trade. So you're going to keep growing along with your account. You're going to be risking more along the way, and your returns are going to compound over a longer period of time. Now, the other thing, it seems pretty obvious, but a lot of people just make that one funding to the account and then they forget about it. And just trade with what they've got. If you're doing okay and your trading approach is working for you and your account is growing, then why not throw in some more money into the account on a regular basis? Treat it like a savings account. If you start off with £1,000 your account, you could just chuck another 50 quid into your account on a monthly basis. It's probably one night out down the pub that you might have to miss, or a meal out with the wife, but every little helps along the way. And if you keep adding to your account, treating it like a savings account, and adding in the effects of compounding as well, then all of a sudden your account is going to start to accelerate. Now, it's going to take a period, it's going to take a long time. You have to think long term. This isn't a get rich quick scheme, and if you think it is, then you're in the wrong place. But if you're looking to make gains over a long period of time, use compounding and keep adding money to your account. And I'm going to show you an example of this. And one of my favorite ways of demonstrating this to people is through a compound calculator on the internet. Let me just share the screen. So this is the calculatorsite.com, and it's a compound interest calculator. So I've set my base currency as pounds. Let's say you start off with £1,000 in your account. That is your initial money that you're going to throw into the market to cut your teeth, to see how you get on. Now, if you can make, a lot of people come in and think I'm going to double my money in a month. So that means you're going to have to make 100% a month. There's hedge fund managers that would give anything for 100% a month. It just doesn't happen. If people make 20 to 30% a month, a year, then they've had a fantastic year. It's all relative to benchmarks at the end of the day, unless you are a hedge fund and you're trying to make absolute return. But let's just put this as a sensible number. If you can make 3R a month, so 3% on your account on a monthly basis, and yes, you've started your trading journey now, but if you're 20 years old, then why not trade for the next 25 years doing this? You'd only be 45 at that point. Might sound old to you now if you're 20 years old, but it really isn't in the grand scheme of things. For me, as a 35-year-old, I could still have this 25-year horizon and be 60 years old. And you'll see how it looks in a minute. And if we compound these returns on a monthly basis, so we're going to keep rolling it, every time we make a 3% gain, we're going to roll that in. And if we just add another £50 to your account, as I said, that one night down the pub, if you chuck that into your account on a monthly basis, as well as making you 3% a month, and hit the calculate button, in 25 years, you'd have an account balance of 19.28 million, 282 million pounds. So, that's pretty special. You're making 600 quid's worth of deposits, and you're making an effective annual rate of return of 42.6%. That's just making 3R a month, which just 3R a month sounds doable. It is bloody hard, let me tell you. But, think long term, make regular contributions to your account, and let compounding do the work for you. So that is that. Hopefully that makes a bit of sense. Again, just fire back to the PowerPoint. And the last bit of just a couple of books. We're all stuck at home at the moment, so use this as a chance to try and educate yourself. These webinars are obviously free, and we're doing it because we want to help people. There's obviously much more learning you can do. There's infinite amounts of literature and educational material on the internet. Any books by Dr. Van Tharp, if you were interested in what I spoke about with regards to position sizing, he was the he was the guy who really opened my eyes to position sizing. So check out anything from him. If books aren't your thing, there's plenty of things on the internet visually that you can look at as well, other videos, and of course audiobooks as well. If you're just sitting there, going to sleep at night, stick some earphones in and just listen to these books. Subconsciously you'll be taking it in, and it'll all help. And just another couple of books for you to take a look at. These are sort of more general reads. They're not too heavy. But Reminiscence of a Stock Operator by Edwin Lefebvre is about Jesse Livermore, one of the most famous investors of all time. Fantastic read. And also anything from Jack Schwager on the Market Wizards series. I think there's about 4 or 5 of them. Check those out, whether it's through audiobooks or through paper books. They are fantastic reads, and you will learn significant amounts by checking them out. Hopefully that was useful for you all. I'm going to go and sit out in the sunshine with my kids and have some lunch now, but I'm here if you need anything. You can email me, you can Skype me, you can contact me on Telegram, and Ian will be back later with another webinar for you all to enjoy. So thanks for watching, and I'll be back with you all again soon. All the best.